Fed Chief Jerome Powell telling the Senate Banking Committee today that he is committed to bringing down inflation, but he acknowledged aggressive rate hikes could tilt the economy into a recession. He'll be back on the Hill in front of the House tomorrow. Our next guest warns a recession is almost a sure thing. Peter Boockvar is the Chief Investment Officer at Bleakley Advisory Group and a CNBC contributor. I mean, almost a sure thing. You say 99% here. The question is, how deep, how long? What's your take?
Well, you make an important distinction, because I do think the question is how long, how deep, mild or not, rather than are we going to have one. And I think it's possible that we have a mild one, but when you have a mild recession, that doesn't necessarily lead to a quick snapback, as opposed to a tough, sharp decline that usually leads to a sharp rebound. So I'm not sure which is necessarily better here, but I think it's still inevitable that we do get negative rates of business activity when we look to the back half of this year and even to next year. I know some people think it's not until 2023, but I think we're either the beginning of one or just on the cusp of one.
Powell today was asked about the possibility of a 100 basis point hike, and he didn't rule that out. Do you think that he's getting more hawkish? Do you think that he's trying to get the markets more comfortable with a Fed that is much more hawkish than it was even just 2 months ago?
I think it's his way of telling the markets that he's still very serious about trying to engineer a sharp slowdown in inflation. And I say sharp rather than a slow rate of change on the decline of inflation. I don't think they go 100 at all, because I still think at the end of the day, they're going to be very sensitive to the economic implications of what they're doing. And Powell also acknowledged that, yeah, we could have a recession. But that typically is what happens when the Fed tightens, is you end up getting a recession.
Hey, Peter, Tim, is Powell basically Paul Volcker dealing in the aftermath of Miller and Burns, and as opposed to, Powell dealing in the aftermath of Bernanke and Yellen? I mean, and is the dynamic very similar, which is a psychological overcoming of inflation? And what might be different, though, is the structural labor market changes, and where it's going to be really difficult to reverse the move in the labor market. So I'm just, how much of this is psychological from the Fed at this point, and how much of this is really what they've got to continue to do?
Well, I think that they were embarrassed by what they've presided over, and I think for the sake of Powell's reputation, he does not want to be Arthur Burns. You make a point that's important about the structural change in the labor force, and that then keeps inflation elevated. And then that gets to, okay, what happens next? Let's just say that the economy is in a recession and inflation is only slowed to 3 to 4%. Does that all of a sudden become tolerant by the Fed rather than trying to push that down to 2? And I actually think the answer is going to be yes, because they'll more lean towards helping the economy than getting that inflation rate back to 2. And we keep in mind, 2 is still just an arbitrary number. I think right now they want the direction of inflation to go down, and to go down as quick as they can, without causing too much economic damage. But I don't know how you can have one without the other.
Peter, great to get your thoughts. Thank you for your time.
Thanks, Melissa.
Peter Boockvar. Dan, I think that's an important point that Peter brings up, and that is, what if we are in a recession and inflation is above 2%? They've come out and they've reaffirmed their commitment to price stability almost at all costs. I mean, they're aggressively committed to price stability. That sort of ties their hands just a little bit.
Yeah, so their other mandate is obviously full employment. So if the unemployment starts to tick up, then they're really in a difficult situation. And I think this is one of the reasons why a lot of us, Peter is a great macro mind, but he also reads the Ks and the Qs of a lot of individual companies, and he takes a lot of things out. And it really feels like, by reading his work and what he's just had to say here, is that we're kind of just on the precipice of figuring out what a slowing economy looks like at a time where I don't think any investor that I know, at least in our age group, can remember a time where the Fed's hands are so tight, because usually their playbook is to get easy, or at least talk easier. And I don't think that's a situation they can really do, because, again, inflation is going to stay way above that target for a long time, and unemployment is still very near those pre-pandemic lows.
The unemployment part, I think, is interesting. I mean, we have passed what we used to think was maximum employment, right? So I do feel like the Fed does have some room. Again, it's another painful byproduct of a process of trying to get a handle on inflation. I think they could allow unemployment to rise a few percent. And I still think that they're fulfilling their mandate.
Right. And that was sort of the point, or one of the points that Bill Dudley was making in his opinion piece on Bloomberg today. And that is, consumers and corporations' balance sheets are so strong. So the good part of that is that we're very strong heading into this tightening cycle, into potential recession. At the same time, that means that the Fed will probably have to slam on the brakes harder, so to speak, Steve, in order to dampen that demand. If people have all the money in the bank to still spend on whatever it is, prices will still stay high.
Yeah, and when you talk about a garden variety recession, I don't really know what that is, quite frankly. So, and then throw in China, and then throw in Russia. So there's going to be, I can't assess what a garden variety recession looks like to start off with. What I can assess, though, is that if Peter's talking about the recession hitting in 2023, or we're on the cusp of it right now, the market is usually ahead by 6 months. You're going to see a buyable bottom way before we even talk about how this turned out.
What history tells us about a bear market that's inflation caused, as we've had 3 or 4 of them, is that they're not quick events. They're 18-month events. And so that's the troubling part about where we are today.